All right, back to Jack F. Second question. I read something that the market makers drive the stock towards the strike price of an option they call the max pain. So as options trading, how can you make a judgment call as to where the max pain point possibly could be? Easiest answer to that, Jack, is to use the strike of pain tool on PowerOptions, which is based on the same thing, the max pain calculations. One of our signature tools. Last week, we covered 3 of the signature tools. We talked about the long option finder to help you find the best long call or long put to buy based on your expectations of the stock moving forward. The stock repair tool, if you didn't have a married put position, but you were in a stock and it fell, this will help you show you potential ratio call spreads that will help you get back to break even faster. And in the case of what Kirk mentioned, if I did buy the stock based on my technicals and it did work out that 60, 65, maybe 70% of the time, what is the best put to buy to lock in the most guaranteed profit of my unrealized gain? That's what the insurance tool does for you here in the signature tools. And now we have the strike of pain. What is this max pain discussion, this quote unquote pinning that most market makers feel that the stock's going to gravitate towards a certain option strike at or on an expiration date? Well, it came out, I think, in the 80s, mid 80s. It's called the max pain calculation. And it's not just looking at the straight open interest of all the calls and puts. What it's looking at is the value of, if the stock is trading at the certain price, if I take the intrinsic value of all the in-the-money calls and puts at that price, and the intrinsic value of all the I take the intrinsic value of the in-the-money calls and the in-the-money puts and multiply that times the open interest, it gives me a monetary value. And the discussion was, well, the thought was, and the equation came out to be, what happens? Why did that not pull up the expiration date? There we go. Okay. Sorry about that. What happens? The equation shows us that, hey, at these prices, hey, if XOM at 124.83, we have a high pain value at 55 here, but it's a small open interest. And what this tool is showing me is that in 14 days, right, I took that October 18th expiration, the pain value is at 116. Right now, what is the pain value? And I mean, so we're doing single strikes, so you see that they're very similar. That yellow mark here is the pain value. And it's all very similar in these strikes because they're all really close. In the older days, when you only had 5 strikes or 10-point strike differences, it was much clearer. Now that you've got the 50-cent strike differences and the dollar strike difference as well, it's within a range. But here's the idea. The highlighted one is what has lowest pain value. The expectation here on this tool is that this is where option buyers would lose the most money and option sellers would make the most money. Okay? So sellers make the most money. And that's the equation. This is the tool that shows where it is likely that this is where it would happen right now. If the stock was trading at 116, the value of all the in-the-money calls times their open interest, the 115 calls times their open interest monetary value, and all the in-the-money puts times their open interest, their value, this is where the lowest pain value would be, where the option buyers lose the most money and option sellers make the most money. Okay, that's what it's looking at. And on PowerOptions, we call it the max pain tool. It's the same calculation. The strike of pain tool, same calculation. We, said to them, and they said, sure, show it. You just can't call it max pain. All right, so we call it the strike of pain tool. That's what it is. Now, caveats on that, Jack. In the old days, as I mentioned, with more strikes available, with different market conditions, different ways orders were placed, less automation, this showed a relative frequency, I'd say maybe about 65 or 70%. 65%, 70% of the time, you'd see the few optionable stocks, the 300, 400, 500 optionable stocks on the market gravitate to a specific price. And this is where it showed it would be based on this value. Nowadays, with a lot more money in retail investing coming in, the ability of online brokers, automation for the market makers, and orders being placed, electronic market makers, things of that nature. 2 things about this. The last time I did tests on this, 9, 10 years ago, taking a basket of about 50 stocks and running it over the course of several expirations. And you can also tell now when I said that, but 8 to 10 years ago, if I'm not mistaken, there were only 80 stocks at the time and indexes that were offering weekly options 8 or 10 years ago. Maybe 200. Is a very small amount compared to what it is today. And you also had, very rarely did you see 50-cent strikes or single dollar strikes, even with the weekly series at that time. Long story short, Jack, take a basket of 50 indexes, ETF standard ETFs, and other positions as well. Common stocks, IBM, XOM, Bank of America, the ones that were offering the weeklies as well. I have to dig this up, Jack. I apologize. The number surprised me. It was relatively high. It was about 56% of the time. Over a 5 or 6 day period, would you see a stock gravitate towards this value? Now, what does that mean? Well, it doesn't mean it ended right at 16. Scientifically, you have to give it a little gauge. So 56% of the time, the stock ended within +1 or +2%, plus or minus 2% of what its strike of pain was. Now, again, in those days, when you had only 5-point strike differences, 10-point strike differences, that was pretty good. I'm looking at a $100 stock. I have the 100 strike. 56% of the time in the last 5 days, the strike of pain is gravitating me towards this 100 strike. That's fantastic. I want to be selling that because it's saying, hey, it's going to be within 1 or 2% of here. If you can get 4% premium right now, that's fantastic. Take it. But now we're talking about strikes that are $1 apart. So 56% of the time, we're in 1 to 2% of the strike of pain. Well, if I sell the 116 and it's at 118, which is still within the 2% range of 116, that's not at all what I wanted to have happen. Especially if it was a naked call. That's not at all what I wanted to have happen. I don't want it to be above that by 1% or 2% at all. And I think it was about 56% of the time, it was 1 to 2%, about 40%. I know this is high. 40% of the time, it was in about 3 to 5%, and the remaining, it was in like 7 to 8%. That was in a 5-day period leading up to the standard weekly expiration. Go 10 days out. Okay, whatever this was, 15 is that? So we're at 90. Okay, so it was more like 8% here. So maybe it might have been 54%. I can't remember. So it was just right that is 8%. 10 days out of time, it sort of flipped. It went to 40 at 1 to 2%, 56 at 3 to 5%, or whatever they almost flip-flopped. And then this one was actually just a little bit higher at the time. I know these numbers don't add up right. I'm just using this as a gauge. And then when I went 20 days out, 10% of the time, it was in the 1 to 2% range. It's 50% of the time, I'm just going to say, it was in this 3 to 5% range. And 40% of the time, it was beyond that 5 range. It was 5 to 10% in or out of the money away from the strike. That is sort of the key. The numbers here look pretty good considering what this is as a pinning tool. The complexities now are smaller strike differences that you have to pay attention to, but the main thing that I remember from that test is exactly what's shown here. Even with just a little bit of variance, a lot of the trading now especially is happening in the last 5 to 6 days. Everyone loves the weekly options. Everyone loves the daily options on SPX, the zero data expiration options. Trading as short term as possible. I had to talk with a customer this week. I didn't realize this. I know some of you did. But I saw a pattern in a cycle that I didn't realize for SPY and QQQ 2 years ago. Before they offered the daily expirations, IWM, before they started offering those, they had a Wednesday and Friday series. So every week or two, they would just have a Wednesday and Friday series, 2 days a week. And then eventually they had the dailies. Right now, I ran a search and it's starting a cycle again with other ETFs. Now, this happened several months ago. I just missed it. But USO, GLD, I think OIH as well, and SLV, they are now starting to have a weekly Wednesday and Friday series. And if I'm not mistaken, let's take a look in a minute, but it might be a Monday, Wednesday, Friday series now which means eventually those 4 securities, they're gearing up to have daily options, just like SPY, QQQ, SPX, and NDX. So and that's just something to keep an eye on, that eventually there are going to be more series that have daily options. Let's take a look at GLD real quick here. But that's the strike of pain, Jack. Signature tools, strike of pain, put in your symbol and your expiration. Okay, let's do that. 14 days out, we saw it was the 116 strike is our strike of pain. Let's go 7 days out. Is it going to change? Should be around 116, but I'm not going to be surprised if it's 114 or if it's 118. No, it's 119. That's interesting, isn't it? So next week, the strike of pain has us at the 119 strike. 2 weeks out, it has it below that at 116. It's about a bearish move after a bullish move, taking XOM up to 119, dropping it back down to 116. I'm on XOM, right? I stayed with that one. Or 124. They're both bearish moves, aren't they? The current stock price at 124.83. The strike of pain, where it's expected to gravitate towards now in 7 days, is the 119 strike. Now, this is going to fluctuate day by day. Going into, let's do that. Let me write down my note, Jack. XOM, SOP, week of October 11th. Strike of pain every day. Okay, so let me just jot that down. Close of day. I'm going to do, close of day. Got to do a close of day because that's when the open interest is updated as well. Okay, so we're going to look at that there, but you can look at it too on PowerOptions. You can go through it each day or with your stock if you want to run that example. I just wanted to go to GLD real quick, guys. Let's go to the chain. Let's go to, yep, there it is. So October 7th, Wednesday expiration, 3 days out. Standard. Oh, my apologies. We are. GLD is the one that's Monday, Wednesday, Friday now. And then 14th, 16th, 18th, 25th, and it stops there. And then it just goes to weekly. So you have 2 weeks of Monday, Wednesday, Friday expirations. So in some time in the next few months, it looks like this one, GLD and SLV, are gearing up to be daily frequencies eventually. What was the other one I mentioned? USO? Yeah, there it is. So USO is only on the Wednesday-Friday series for the next 2 weeks out. They don't have a Monday series yet. So shortly in a couple months, don't be surprised if USO and OIH, I think it was OIH, folks, just give me one more try on that one. Oh, nope, they're just at 7. I lied. My apologies. But it was USO, and I think there's another oil one that's out there as well. Natural gas. I think it was the natural gas one. They've got the Wednesday, Friday series available 2 weeks out in times. Gold and silver, GLD and SLV. They've got the Monday, Wednesday, Friday series out. Eventually here on USO and the natural gas one, you'll see the Monday, Wednesday, and Friday, the way things have been going. And then eventually you'll see dailies on GLD, SLV, eventually on USO, and the natural gas one as well.